Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Kayne Anderson BDC President Frank Karl. Kayne Anderson BDC invests primarily in first-lien senior secured loans with a secondary focus on unitranche and split-lien loans to private middle-market companies. On the show, we discuss recent volatility in BDC prices and what is driving NAV discounts, credit market condition amidst talk of cockroaches and negative headlines from First Brands and Tricolor, characteristics that make core middle market direct lending attractive for investors, an update on private credit spreads and payment-in-kind loans, and more. A point of disclosure, the Accelerate Diversified Credit Income Fund, INCM on the TSX, does hold a position in Kayne Anderson BDC, referred to as KBDC, on the podcast. So with no further ado, here's our show on Beyond the Headlines, the outlook for private credit with Kayne Anderson President Frank Karl.
All right, we have Frank from Kayne Anderson BDC and going to be chatting about private credit on the show today. Massively growing space. Been a lot of news stories as of late, both good and bad. We want to touch on both. But prior to getting into the weeds, Frank, I was wondering if you could walk us through Kayne Anderson's private credit platform and strategy. In addition, how KBDC, the traded BDC, fits into the platform.
Thanks, Julian. I think to start, it's sort of important to define these markets. It's hard to describe our platform without describing sort of the market where we play. And it's especially important because there's no universally accepted delineation, right, between these markets. First, you've got the lower middle market, which I think about as sort of 5 to 25 million of EBITDA. From there, you've got what we think of as the core middle market, which is, let's call it, $10 to $75 million of EBITDA. And then you have the upper middle market, which is realistically probably $75 million plus of EBITDA. Obviously, the lines between all of these are blurred and there's no perfect definition, but directionally, I think this sort of helps, right, paint the landscape. For our platform, we are a privately held middle market direct lending firm. We focus in what I defined as the core middle market, so that $10 to $75 million of EBITDA. Our median borrower is $35 million of EBITDA, just for a sort of a sense of scale there. We are an $8 billion AUM platform focused on investing in directly originated, agented, senior secured loans to private equity owned middle market companies. And when you sort of say the mission statement like that, it's a little bit of a mouthful. KBDC inside of that is about $2.2 billion of our, about $8 billion. So a little more than a quarter. So said another way, I mean, it's an integral part of our business and what we do. We formed KBDC back in 2021 and invested for about 3 years before executing an IPO in 2024. As you think about strategy, I like to think of our business in a few key contexts. First, culture of conservatism. It is a first lien focused business. We're investing in what we think of as stable companies in staple industries at low leverage levels with PE, private equity partners that we know, right? All aimed at building durable portfolios, generating healthy yield. And just to point it out quickly, our average leverage at the borrower level is a little over 4 times, about 45% loan to value. This compares to larger market average leverage more like 5.5 times. So we think that our investments are just structured with a little bit of incremental cushion on cash flow. You got less dollars going to debt service, less debt on these businesses. I already mentioned, right, we're focused on that core middle market. We think that's sort of the sweet spot where businesses have typically been around for a long time. They have professional management teams. They have quality reasons to exist. but they're not so large as to attract the attention of the largest lenders and asset aggregators in the space or touch the broadly syndicated market. I'll put a pin on that market focus and why we like it. I think it probably makes sense to talk more about that a little bit later, but in the interest of trying to be somewhat focused on the question at hand, try to stay focused on our platform. I think the last piece, right, so we touched on culture, conservatism, leverage levels, right? Second, the market we're focused on. Third, on our strategy is just, the way we actually structure these loans, you're setting them up with tons of downside protection.
Right.
About 95% of our investments are first lien senior secured. We're top of the capital structure. Again, leverage level around 4 times, loan to value around 45%. With a lead or co-lead 75% of the time, which means we're driving documentation, we're driving negotiations, we're controlling our own destiny in workout situations. We're not along for the ride in other people's deals. And we have covenants in 100% of our deals. So it means we get a seat at the table early and can force action, whether that's incremental economics or forcing a sale. So that's kind of like the high level as to who we are, what we do, a little bit of how we think about the world.
Great. Thanks, Frank, for providing that introductory summary. Now, for our viewers and those who participate in the market, the BDC market has gone through a bit of volatility lately, and there's been headlines, whether it be related to kind of First Brands and Tricolor, which not really touching the private credit market, but nonetheless causes some fear in investors. And then you hear from bank CEOs talking about cockroaches. And so there's some negative sentiment that's floating around, and there's been some pressure on BDC prices. What are your thoughts on kind of what's driving the volatility, and what are you hearing from investors with respect to BDCs trading at discounts to their net asset value?
Yeah, it's an interesting thing. We clearly don't think that the current trading levels and sort of the magnitude of the pullback in prices were or are reflective of the realities on the ground, right? I think to your point, there's been some headlines, whether you talk about whether those are sensationalized or not, around credit quality in the space. But I think if you take a step back, the last few quarters, from an actual what are BDCs reporting and what are you actually seeing at the company level, been mostly a story of stable credit, right? Relatively flat non-accruals. There has been some uptick in PIK over the last couple of quarters, something we can talk about, but not to the magnitude that would make you think, hey, there's a huge amount of very bad situations hidden in these portfolios. And the economic backdrop looks, look, I'm not a prognosticator, but most of the high level data sort of points to an okay, right, sort of macro environment. I think the precipitating factor for the sharp decline appears to have been announced rate cuts in September, which I think just crystallized for much of the retail market that, hey, total earnings power for some of these BDCs is going to go down, right? Forward curve is pointing down. Now we're actually seeing it. I do think it's fair to say that doesn't tell the whole story, right? Like rate cuts, SOFR curve, that wasn't a surprise to anybody, right? A big part of the Fed strategy is to not surprise people. So I think what you are seeing is there's some, generic concerns around credit quality in the space, even if we're not actually seeing it, just creates noise. When we talk to investors, right, we get questions about dividend stability for us, for the space generally. It's the things you talked about. It's competitive financing environment. We talk about spreads, right? But they're mostly flat, but they're down relative to the last few years. Forward curve that's pointing down, although not as sharply as it was previously. And, the third piece there is, what does credit look like? So again, I think the market is telling you they think there's more space, that there's, more there on credit. We haven't seen that. Our portfolio has continued to hold up very well, but I think the space generically is going to have a little bit of a prove it phase for the next couple of quarters before you see it, trade back up to closer to NAV.
That makes sense. And KBDC, along with most of the BDC market, reported Q3 results. And as you indicated, credit conditions fairly benign, as are non-accruals and kind of all the warning signs and indicators point to sort of steady as she goes, particularly if you look even compared to last year, you had some kind of high-profile deals gone bad, like Pluralsight and Thrasio, and granted, a lot less media coverage of those, ironically. But that said, even with the positive fundamental results from the BDC and private credit space in the third quarter, indicating positive credit quality, I have heard some skepticism regarding portfolio marks on the loans that you hold. So what would your response be to those who are skeptical on the loan fair values?
I think that, look, I can't speak to everyone's process and for the time spent and the analysis done around arriving at fair value of the loan portfolio. All I can say is that, at Kayne Anderson, we have a very robust valuation process, including the involvement of multiple third parties and, valuations that are ultimately signed off on by the board. So we think we're as careful as you can be in getting the loan values. But, look, you're operating in a world where, you're marking a loan book based off of the information that you have on hand at that time. And clearly there are instances where businesses can underperform or overperform expectations, so that you're going to see some variability in marks over time. But I think you're really, you're looking to the sort of governance structures of the BDCs and the quality of the management teams into who's been doing this for a long time, who knows, hey, when loans are impaired versus not, do these businesses have upside, do they not, to create some confidence in marks on the loan book.
And then just to back up in terms of the overall space, from an allocator's perspective, what are some of the characteristics that make your core middle market direct lending such an attractive space, especially, I guess, relative to other areas of credit?
Yeah, it's a good question, because it sort of gets into a broader discussion around, that's why I raised the very top, like, how do you define these markets? Because they're very different, right? Like the financing market for a business that has $240 million of EBITDA is very different than the financing market or the M&A market for a business with $25 million of EBITDA. And I think it's especially important right now because, and Julian, this goes to your earlier comment around headlines, right? They're not just around credit quality or high profile issues. They're also sort of a generic question around the amount of capital raised in the space. And does that lead to sort of lackadaisical underwriting standards, right? So I think about it this way. If you think about the core middle market relative to, this is mostly a discussion about sort of lower middle market, core middle market, vis-a-vis the larger market. In the core middle market, right, it's attractive for a number of reasons. You can generally finance these businesses at lower leverage levels than the larger market. You can generally generate a higher spread on those investments. You have tighter documentation, inclusive of financial covenants. As an example, we have financial covenants in all of our deals, right? This exists because there's a perception that smaller businesses, and again, we're not talking about small businesses here, but smaller, there's a perception that those businesses are definitionally more risky than larger businesses.
Right, and you're talking about businesses with enterprise values generally in the 9 figures or greater.
Correct, yeah. $25 million EBITDA business, or $30 million EBITDA business might be worth $300 million, right? These are not sort of mom and pop, one single shingle type operations. These are scaled companies. Our perspective on that, right? Like, hey, is a bigger business definitionally better? I think it's true to a point, right? Like a business hits, and I don't know what that point is exactly, but we can't find any data that says that businesses in the upper middle market, so call it greater than 75 EBITDA, and most of these realistically are north of $200 million of EBITDA. If you're looking at the public BDC space and you go down all the largest managers, some of them report average EBITDA in their portfolios. It's all 280, 225, 250, 198, like very large businesses. We can't find any data that supports the notion that loss rates for lenders in that market are actually lower than they are in the core middle market. We actually see data that says loss rates are better in the core middle market than the larger market. Because even if I granted to you that a bigger business, 200 million of EBITDA versus 40 of EBITDA, was definitionally a better business, it's not the only thing that matters for outcomes for lenders, right? Do you have covenants? What does your collateral package look like? Can you actually force action before the company runs out of money? Like, all of those things matter vis-a-vis, like, does a lender get their money back or not? And I think it's worth sort of spending just a quick beat on what drives the differences in those structures, right? We're talking about it. Core middle market, lower leverage, higher pricing. I'm arguing less risk in the upper middle market, right? And it's sort of well, why is that? I think first, the scale of the market is huge. So in the US alone, there's something like 125,000 businesses between $25 million of revenue and $2.5 billion of revenue. 125,000. Half of those are 25 to 50 of revenue. We're not really focusing on that space. That's sort of lower middle market, right? Most of the other half is between $50 million of revenue and $500 million of revenue. It's about 60,000 businesses. There's only about 6,000 businesses that are between $500 million of revenue and $2.5 billion of revenue. So like 10 times more businesses in the core middle market relative to the upper middle market. You can then compare that to the amount of M&A value in each of those markets, and they're about the same between core middle market and upper middle market. So sort of that implies there's just more transactions to be done in the core middle market versus the upper middle market. And it leads to a more fragmented space where you can actually generate some alpha, right? It's not everybody sort of attacking the same transactions, tons of portfolio overlap, a little bit of a race to the bottom, for lack of a better way to put it. It's a, by definition, more fragmented market with more buyers, more sellers, more companies, more financing partners, more investment banks, and you can sort of differentiate, inside that universe.
That makes a lot of sense. Appreciate that insight. Now, in terms of portfolio strategy, there's been some changes at KBDC, particularly because you were one of the newest listed BDCs going public in early 2024, and as part of that sort of private to public transition, you did have a bit of a broadly syndicated loan portfolio that you have kind of slowly transitioned into being purely private credit over the past several quarters. Can you discuss how that strategy is playing out? What's the reasons behind it and your outlook for those two markets?
Yeah, so, it's the broadly syndicated loan strategy for Kayne Anderson. We invested in about $300 million of broadly syndicated loans. It was really a point in time execution piece of our strategy, right? We did the IPO. We were not yet fully levered. We had some excess availability, and we made the determination that, it was better for us and accretive to our shareholders to invest in broadly syndicated loans and deploy that capital, put that capital to work, as opposed to sitting on cash or excess liquidity for, a few quarters. We're fortunate that we have the capabilities internally at Kayne Anderson to execute a strategy like that. We have a liquid loan team who's in the market every day. I think we have a good sense for what are managing your buy and sell process and hitting the market at different times, et cetera. But that was more of a, hey, let's deploy this capital in an accretive way, but with a a real look at do no harm, right? I mean, that was a B+ or better book, and one that we've unwound. I think that for KBDC specifically, we're not planning to continue to invest in broadly syndicated loans as part of our ongoing strategy. I mean, never say never. If you sort of have a point in time, we've got a lot of capital returned and maybe the market makes sense. But we're most focused on sticking to our knitting, right? Which is core middle market, senior secured lending, where, it's a several hundred basis points delta in yields between what we're doing day to day versus the broadly syndicated loan book.
When you look at the current kind of topics du jour in the BDC market, one of the main topics has been worries around payment in kind or PIK. Do you think that the investor concern currently around PIK is valid? Do you separate between good and bad payment in kind? And then secondly, do you see any changes in the industry as we move forward and the investor focus on this to include more disclosure around the PIK books within the different BDCs from management teams?
Well, I think the disclosure point, I mean, in my mind, hey, sort of disclosing the composition of your income is sort of a no-brainer, right? Like, what are you actually getting paid in cash versus not, particularly in a structure where you have to distribute 90% of your earnings? I think it's a very reasonable question as to how much of that are you actually getting in cash. I think as far as the PIK question more broadly, undeniable that there's been something of an uptick in PIK, right, over the last 18 months. I mean, Lincoln did that study where they sort of laid out all the BDCs, what are PIK rates over time, how much of that is good PIK, like who had PIK at close versus not. And I think the general point there was like PIK income had effectively doubled, right, for the large BDCs over sort of a 4 or 6 quarter period. That's not nothing, right? That's a meaningful change in the composition of your income. Quick plug, I mean, we're at about 2.3% of total income in PIK, much less a part of our strategy, right? When you're lending at lower leverage levels, these businesses generally have enough cash to pay their interest burden. But I will say, as with most things in this market, the amount of PIK on a portfolio can be something of a nuanced point or a nuanced discussion, right? It's not always the case that a business is paying some of its interest in PIK and that means that business does not generate enough cash to pay its bills, right? Oftentimes you'll see, some level of underperformance. Maybe there's a foot fault on a covenant, performance is down, but lenders are still way inside the money. Private equity firms are contributing capital to support a situation. And, as a trade for that, right, lenders will take PIK income as either a form of incremental compensation, right, if they're feeling that their risk has been elevated, or as a bit of horse trading, right? Hey, private equity firm, if you guys put in $10 million of equity to support liquidity and give this business more runway, right, like let's really give it a real go here, we'll pick some interest to sort of match that at some level in a collaborative way. So, I don't think that implying payment default rates off of like the amount of PIK interest out there I don't think that's a one-to-one, conclusion you can draw. But it clearly means there's a little bit of incremental stress, right, in the portfolios. Because even if it's not, hey, we're paying you PIK because we can't pay you cash, even if it's, hey, incremental economics to lenders, there's something there as far as an increase in the risk profile at some level. It also, I think, is worth calling out, right? Like, depending on the types of businesses you're investing in, and the BDC space is one where a lot of the largest loan books have substantial software lending portfolios, right? A lot of those are burning cash or, not generating much cash, at least vis-a-vis the debt stack. So providing, some PIK options has been normal course in that space for quite a long time. I do want to clarify, we don't do any software lending at Kayne Anderson. It's part of, the whole strategy where we're investing in sort of, slower growing, more stable businesses. And part of that, is a lower PIK income profile.
So you guys aren't getting caught up in the AI is killing software thesis that has been going around. And one thing that I did want to discuss, Frank, you mentioned the SOFR curve, Fed rate cuts, and obviously BDCs and private credit are primary floating rate loans for the most part. And with that, they will change with base rates. That said, the concept of spread has a significant impact on investment income and therefore dividends to investors. And from what I can see from an industry perspective, spreads have broadly been stable but dropped compared to, say, 18 months ago. In your third quarter, we did see an uptick in spread, which is directionally positive. In addition, we look at one of the drivers of deployment, actually a couple dynamics happening behind deployment. And one thing that's very recent is obviously as listed BDC prices have traded down, perhaps that's having an effect on fund flows in the non-traded space, which can affect deployment if they're getting still a tremendous amount of inflows, perhaps those stop, or even reverse if investors find more attractive opportunities in the listed BDC space. In addition, a large portion of BDC capital goes to financing private equity buyouts. M&A activity has been significant. We just saw a $10.3 billion leverage buyout announced this morning, a CD&R striking a deal to acquire Sealed Air Corp. We just saw the largest leverage buyout of all time get announced a couple months ago, with EA being taken private by Silver Lake, in addition to many other large private equity transactions. So just wanted to get your thoughts on direct lending spreads and how those are looking recently.
Yeah, I think that it's worth probably thinking about the longer term history and some perspective there. Since 2012 at Kayne Anderson, and we've been doing the same thing this whole time, right? Core middle market, senior secured, private equity backed lending. Our average spread has been right around 600 basis points. Over the the year to date, call it third quarter period, we're right around 550 basis points. And as you noted, third quarter was a little bit higher than that. So there's been something like 50 basis points of compression, right, relative to the long-term average. Now, there's been a slightly larger amount of tightening relative to the spread we saw in, call it, 2023, when the market, that was sort of it's funny, I'm getting a little bit of whiplash. I feel like 2 years ago, I did tons of golden age of private credit type discussions, right? And now it's, hey, potential credit issues and First Brands and too much capital type discussions. But relative to 23, when you had, really sort of inflation still rolling, rates increasing, sort of maximum conservatism from the lending community, down a little bit further since then. I think we saw most of that tightening happen, call it back half of 24 into, some of the first half of 25. And to your point, since then, spreads have been, mostly stable. Again, we're sort of in that 550 plus or minus range. I think that the larger market is probably in that 475 or 500 plus or minus range. So, we're seeing a mostly stable market. I think you do raise a good comment around supply-demand dynamics, right? It's a hard thing. I think we talk to investors, and there's sometimes a perspective that, hey, sort of the market only gets more competitive, and and spreads only go down. That's not been our experience historically, right? There's stretches in time where the market is somewhat aggressive, and you could characterize it as euphoric, and spreads get very tight and very conservative, and spreads widen. And it's also driven by, the M&A market. I think, yes, there were a couple of really large deals in North American private equity or global private equity over the last couple of months. A few of what you mentioned, but at a high level, like North American M&A activity is not nearly what it was in the 2021 timeframe, right? And since that time, there's been a substantial increase in the amount of private equity dry powder that's available to invest in the space. I mean, right now it's like $1.5 trillion in the U.S., in North America, of private equity dry powder. That number was 700 billion in 2017, so it's more than doubled over, call it 7 or 8 years. Private equity companies own 28,000 companies right now, worth something like $3 trillion. Those are touching a 4.5-year average life. So there's a few factors, structural factors, which we expect will push increased M&A volume. over the next, call it 12 months. Now, I don't want to be the boy who cried wolf here. I feel like the market's been talking about, hey, step ups in M&A volume for the better part of the last year.
Yeah.
But anecdotally, I said this on the earnings call, transactions we reviewed over the last quarter, the mix has increased towards M&A versus prior quarters, more refinancings, more add-on transactions, et cetera. So early signs, but that would indicate more demand for financing, which should have a buoying effect on spreads.
That makes a lot of sense. And another concern that investors have is, as it relates to kind of non-accruals and loans that are underperforming. I did see a quote by a well-known bond fund manager saying in private credit, the mark is either 100 or 0, which is a bit extreme. But I did want to get your insight into what happens with an underperforming portfolio company in your loan portfolio and in the scenario where it needs to be restructured. What typically happens there? And where do you generally see recoveries at?
Unfortunately, there's been, I feel like, a couple examples over the last month or so where you're probably right, and there's going to be a name or two that went from 100 to 0. There was just the Renovo recently, right? That was marked at par and is now probably going to be a 0.
Didn't affect you guys?
Did not affect us, no. As far as the process of sort of, hey, how you're valuing these and like the workout situation, is that what you're getting at? Or I guess what aspect are you sort of most focused on?
Like historically, when you have underperforming loans, typically what has happened?
Yeah. I mean, I'll tell you that the example of, hey, you're at par today and 0 tomorrow has not happened to us. Exceedingly rare as a senior lender. And my guess is that, usually those stories have more to them than just some simple underperformance, right? I think you're already hearing about potential fraud, et cetera, in First Brands. I think that's TBD, but, usually, right, from I think portfolio management perspective is probably the best place to start, right? You're getting workout teams involved as soon as a business starts to underperform. I think that importantly for our market, right, we do have financial covenants. I said this earlier, and I know to some people it might be surprising. Yes, you can get financial covenants in senior secured lending deals. We've got a seat at the table to manage a restructuring negotiation before there has been such a degradation in value of the business. The private equity firm is saying, hey, we're flush and we're walking away. And importantly, before there's a liquidity crisis, right? One of the things that we touched on earlier with some of these markets is, if you're doing cov-lite deals or, spring covenant, et cetera, like you might not have an opportunity to actually do anything until the company is calling you saying, hey, we might not make payroll on Friday, right? That's a tough situation to be in as a lender. So we're typically driving, or attempting to drive favorable outcomes well in advance of those situations. That could be equity contributions, that could be increased economics, that could be firms flipping us the keys, right? If that's sort of the point that you get to. But it's all focused on avoiding exactly what you're talking about, which is waking up one day and saying, oh, wait a second, the prospects for this business are fundamentally different and fundamentally worse than we expected. Dovetails with, some of the earlier discussion around valuation and sort of really looking at what is this business worth today? How does that, what does that imply for the mark on our portfolio? So I think the portfolio management piece of it is iterative. No situation is sort of the same, right? But, we are focused on avoiding the surprises because as a lender, it's sort of the worst thing that can happen to you.
Now, from a higher level perspective, you get a lot of questions from investors and allocators on how to approach private credit, how to include it in a portfolio, or why to include it in a portfolio. So from your perspective, if an allocator were to ask you, why include private credit in a portfolio, what would your answer be?
Yeah, I think we went through some of the underlying market dynamics, right? Like, hey, why do we like sort of the markets we play in? Why do we like being a secured lender, having that downside protection, all of that? But I think taking a step back, right? If I'm looking at this and saying, hey, we live in a world of relative value, right? Where do I find the most attractive risk-adjusted return? I look at private credit, particularly in the core middle market, with managers who have done it for a long time, right? Have experience actually operating through cycles. It's about as good as you can do, right? If you're thinking about sort of where else can I invest my money with downside protection, you can invest at the top of the capital structure, senior secured, have covenants, have ways to force a return of your capital and generate something like a 10% yield while doing it, right? We like that trade. I mean, I think I like to call private credit an all-weather asset class, right? I think when you're thinking about the equity markets and even private equity, right, there's going to be substantial variations in return profiles for vintages. If you're looking for a steady as she goes, underwritable asset class, I think this is about as good as you can do. That's non-correlated, or at least, look, I mean, I would like to say non-correlated. Clearly, the public BDCs do show some volatility with broader equities markets.
Now, from a more micro perspective, there's a lot of BDCs out there, both traded and non-traded. You discussed a lot of the features behind KBDC, first lien focused, stable companies, sponsor backed, 45% loan to value, low PIK, low non-accruals, covenants. Are there any characteristics of KBDC that you have not discussed that makes it stand out? For example, if an investor is looking to buy a BDC or allocate to a basket of BDCs, why should they include KBDC?
Well, I think one, and we've talked about where we focus, how we play in our market. I mean, I think we might be the only, I would say, scaled BDC, right? Call it billion-dollar market cap, that's focused on the core middle market, right? Most of the other players are focused on a much larger market. We've got no portfolio overlap, or effectively no portfolio overlap with those other large players, right? They're investing in a space fundamentally different than ours. We think on a relative basis, our dividend looks very attractive, right? Very senior secured, one of the highest senior loan books out there, right? Ours is not a BDC that's got 30% preferred equity, subordinated debt, equity type exposure. So we're generating something of a premium yield with a first lien book. Third, we touched on it earlier. If you're looking at sort of potential risks, we don't have any software exposure in our portfolio. I don't know what's going to happen in the software space. I heard somebody, it is a bit of a time of a sort of an AI everything, right? Whether we're in a bubble or not. We think our strategy of staying away from tech lending will continue to serve us well. That's not to disparage it, right? People do it very well and have done it well for a long time. It's just not where we focus. I heard somebody use the example of, Walmart and Kmart, and I promise I'll bring this back around, right? Both very successful retailers at one time, right? Why is Walmart still so successful and Kmart no longer exists, right? Walmart became an e-commerce business, hired 10,000 engineers, really focused their e-commerce, they're sort of selling online platforms, et cetera. I don't want to have to pick, if you're thinking about like an AI world where incumbents should win, we don't really want to try to pick winners as to who's Walmart and who's Kmart, right? We want to go in spaces that aren't really going through that rapid rate of change. I think last point I'll make, We have a market leading fee and cost structure. I think it's important to us. People don't really talk about it that much. But we look to be good stewards of our investors' capital. And, we think we can do that with a very efficient cost base.
That's a good point. Yeah, it's a good point, Frank, because that, it goes to the bottom line, goes to ROE, goes to dividends, and ultimately total return for investors. So it's not just the quality of the loan book in base rates and spreads, but also ultimately how the business is run. And certainly a more competitive fee structure is helpful and appreciated by investors. And that's all we got for you today, Frank. We appreciate you coming on the show, sharing your insights in private credit market that's getting a lot of attention these days, for better or for worse, some good, but it looks like sentiment is fairly negative. And I think with positive Q3 results and what's hopefully shaping up to be a positive Q4 for the industry, they can shake some of that negative sentiment. I also find it, just one last side note, how private credit is kind of getting a lot of the flack on some of these, loan marks, whether it's marked at 70 or 90, but there's no attention being paid to the sponsor behind the company that actually owns the subordinated equity, which, is certainly worth a lot less than a 20% drawdown. But I digress. Frank, so much. Thanks. It was just a great show, and we appreciate your insight and wish you the best of luck.
Appreciate the time, guys. Thank you.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.